very warm welcome to you all. Fantastic to see so many people have logged on this very, very cold, foggy morning. Welcome to the second in our series of webinars on the various reliefs available to social housing providers in the UK. I hope you very, very much enjoyed the previous one on Golden Brick. And just a couple of housekeeping points before we start. We've got on your screens, you should have a question and answer box. Please put in whatever questions you need into that box, and we'll try and deal with those as we go. Any questions that you put in there that we don't get round to, we'll try and follow up with you afterwards. But it's really, really helpful, and I think it helps everybody on the call to make some of these things real if those things get done. The other thing to say is that this session is going to be recorded and is being recorded, so other people can see it after the event. So as I said, very warm welcome. Today we're going to talk about the new building and various different building reliefs available to the social housing sector. We'll start off with a conversation with me. I'll talk about new build, conversion and renovations. We'll move on to relevant residential buildings and relevant charitable buildings, which is something which causes still a certain amount of confusion at times. Then we're going to take a deep dive into one of the newer reliefs, the energy saving materials, and exactly where that goes and where that doesn't go. And we'll finally finish off with the revenues, just as a reminder of where the revenue are on retrofitting cladding, obviously following the tragedy at Grenfell. So let's make a start. New build. Should be relatively uncontroversial, you would have thought. However, there is as with all of VAT, there is a certain amount of subjectivity involved in what we're talking about here. And actually, each of the different categories of new build can actually cause their own little issues. The difficulty here, of course, is that in order to get VAT recovery, we need the zero rating. No VAT charged on the services, so there is either no VAT to be recovered, or we don't have to charge VAT, but we do get to recover all the VAT on associated costs, including the land cost, which can be substantial, of course. So we look at the first one. I mean, that's the zero rating for the construction of new dwellings. And we would really start by saying, what is a dwelling? A dwelling is defined in law. It needs to be capable of separate disposal. It needs to be built in accordance with the planning permission, which has caused some issues in the past, but the revenue seem to be are not experts in planning permission, and particularly in planning categories, and can sometimes get themselves a little confused there. And there needs to be no internal access to any other building. And then we come to a bit of a curious discussion, as on the dwelling side, and that is where you start looking at things like rooms and units and care units. When is that a dwelling and when is that something else? Basically, in order to be a dwelling, you need all the amenities of life, as was said in the famous look ahead case. That's living, eating, sleeping, plus toilet facilities. So if you've got a unit which has cooking facilities and it has toilet facilities and bathing facilities, it's likely that you might be able to claim that is a dwelling. The relief for dwellings, obviously, rather more easy to claim than others. And if you don't get charged VAT on the construction of your residential dwelling, then actually it doesn't matter if you then go on to do something else with it. Construction of relevant residential buildings and relevant charitable buildings, Chris is going to talk about in some more detail in a few minutes, but it's worth noting that is also part of that. So what do we mean by construction? Well, the construction is all of the normal construction services, including materials and associated materials, other than the thing called the builder's block. And the builder's block basically stops the zero rating applying to items that are not ordinarily installed by builders. Now, obviously, once again, a very subjective term. What items are not ordinarily installed by builders can range from things like curtains, but also there have been cases around landscaping and plants, etc., because plants are, you wouldn't have thought would normally be installed by builders. Final quick mention of something, I've not seen one for a little while, but there was a little bit of a problem back in the 90s on live work units, as to exactly what the categorization of those. I don't think that ever really got resolved, but if you still build live work units, you really do need to be aware of that. So if we move on to the zero rating for the sale of dwellings, now it says the sale of new residential dwellings is zero rated, and that's absolutely true. It's worth breaking it down though into the different categories. So in order to be zero rating, it needs to be the first grant. So the entity that is selling it can't have sold that entity before. It needs to be a major interest, and that means a freehold interest or a leasehold interest in excess of 21 years. And they need to be the person constructing. Now, I know we covered this in quite some detail in the previous session on golden brick, so I won't labour the point. But basically, you need to either own the land and instruct the builders to do it, or actually be the builder yourself. The other thing worth noting, if you do withhold a reversionary interest and then sell that after you've sold the long leases, that sale of a reversionary interest tends to be exempt from VAT, and occasionally gives a bit of a headache. Often you can treat it as a transfer of a going concern because it transfers the rights to charge the ground rent, but is always worth keeping a wary eye on that. One thing I did want to mention is a very, very specific thing that crops up periodically within the social housing sector, and that is the sale of new dwellings within VAT groups. Now, in order to get the zero rating, once again, you need to have first grant of a major interest by the person constructing. This can cause a bit of a problem if you develop in your development company and then think, actually, we're going to do some shared ownership, say, and we're going to sell it through a different company in the VAT group, and then you move the completed building from one entity in your VAT group to another entity in your VAT group, and then the other entity in your VAT group makes an external sale to somebody externally, normally an individual. The difficulty there is that the intra-VAT group movement of the property is ignored because it's intra-VAT group. The outright sale is not by a person constructing, because the person constructing is a specific status that only applies to one entity within that, but with the entity that was actually involved in the construction. If you are going to be in that situation, it's quite important that the selling entity does do something with the construction. So it could complete the construction. People talk about the golden brick. We've often referred to this as a golden chimney. So when you transfer it into VAT group, make sure that there is some constructural work still to be done, so that the person constructing, and then you get the zero rated sale. And that's massively important, of course, if there's VAT on that land. I know there are situations now with developments that are moving from one category into another, mainly because of the interest rates and conditions externally. So it is something to be wary of. A very, very brief mention before we move on shared ownership. The revenue do accept that shared ownership sales are the first grant of a major interest by a person constructing. And even though there is alongside it an exempt rental stream, the revenue do accept that, providing you make your make your first grant first, and that is a major interest. So you've got to give your shared ownership tenants 21 years. Providing that is the case, you can attribute all the input tax up until that date to that initial zero rated sale. That's really valuable. Possibly not not spot on correct with the letter of the law, but the revenue have always accepted that, and that is a valuable thing. So finally, I'm going to talk about a little bit more about dwellings and what we mean by dwellings. When you create a new dwelling, it is going to be zero rated, even though it is appended to or attached to an existing dwelling. And where we normally see this are things like terrace houses. So if you've got a terrace of houses and you're going to add another property onto the side of it, the construction of that will be zero rated, and the outright sale of that would also be zero rated, and the shared ownership that would be zero rated. Where this gets a bit more controversial tends to be in situations where you've got a block of flats and you're adding units to the top of that block of flats. So you say you've got a 3-story block of flats and you're going to add another 2 stories on it. That would normally be new dwellings, and the zero rating relief would apply. Obviously, very important if you're going to rent those, because if you get a VAT charge, you're not going to be able to recover it because it's going to relate to the exempt supply of rent. So it's really, really important to keep an eye on that. Sometimes you get a problem where you've had a pitched roof. So you've got a pitched roof on top of a block of flats, and then you're going to add another layer of flats on the top. Because it's within that volume of the initial building, that doesn't qualify as a new build. That is really quite difficult and quite complex. Excuse me, to work out. So basically, what we're talking about is anything which is external to the volume of the original building is a new building. So keep an eye on that and be wary of it, but don't automatically assume that you're in one of the other reliefs when you're just when you're adding to an existing building, because if it's an entirely new dwelling outside of that volume, you're going to get the zero rating on that as well. Just make sure finally, demolition of existing buildings. So if you've got an existing building on the site, in order for it not to be a conversion, an extension or a renovation of that building and into the new build territory, you're going to have to demolish that to ground level. The only exception to that is where you retain a facade, or on a corner site, a double facade, which is required in order to comply with the planning permission. And it's quite important to see all those things. So just simply having a facade isn't going to be good enough unless it's a requirement of the planning permission. So it's important to get both those things right. Conversions. Once again, you'd think this was relatively non-controversial, but it's amazing how complex it can get when you start actually trying to apply it to real life situations. So conversions, there is a special rate of VAT, a lower rate of VAT at 5%. So if you are going to incur a VAT cost and you're not going to be able to recover that, obviously you're better off having that VAT cost at 5% rather than at 20%. It goes without saying. Now, that conversion rate actually applies when you're taking anything from one category into another category. So if I'm taking a commercial building into a relevant residential, I'm taking a commercial building into a dwelling, or I'm moving from a building in multiple occupancy into something else. Any movement from one category into another is generally going to be enough to get you into that 5% rate. One of the specific rates there is a change in the number of dwellings. So if I've got flats when I've got 9 units in there and I'm going to increase that to 10 units, the change in the number of dwellings relief can apply to that. Now, the application of that can get a little bit odd, and I've had some really, really strange situations over the last few years where actually you've got quite substantial works and actually you've ended up with the same number of dwellings in each area and therefore somehow not managed to get the relief. Basically, the way you apply that relief is on an area by area basis, and the revenue tend to look at that being tested on a floor area basis. So if you've got a block of flats, again, when you've got 3 units on one floor, if you're going to take those 3 units to 4 units on that floor, then you're going to get the changed number of dwellings. relief. The important thing to remember is the zero rating only applies to the construction charges of the changed number of dwellings. So if you're renovating the block of flats at the same time, then you're going to have to get an apportionment between one and the other. And we'll talk about apportionment in a second. The other important thing to remember is housing associations, they're defined in the law, can get the zero rating when they're converting commercial buildings into a residential building. So if you've got an office block and you're going to convert it into a residential building, then you're going to get the zero rate, providing you are a housing association. And again, housing associations are a specific right within it. So if you've got one housing association in the VAT group, it doesn't mean that everything in your VAT group is going to get that relief. It has to be within the housing association in order to qualify. And that may sway your mind when you're thinking about what entity to use when you're carrying out that development work. Yeah, you can still get the zero rate of the sale of a new dwelling. So if I convert a block of a office block into a block of flats, and I make outright sales or shared ownership sales of that, I'm still going to get the zero rating for the sale, providing, once again, it's a major interest being provided, so in excess of 21 years, and I am a person constructing. And once again, we get that problem within the VAT group if you transfer it from one member of the VAT group to the other who doesn't have person constructing status. So well worth keeping an eye on. And now I'm going to hand over to my colleague Chris Evans, who is going to jump in and talk to us about alterations, renovations, relevant charitables, and relevant residentials. So I'm going to hand over, Chris.
Thanks, Glenn. So I guess from some relatively good news in terms of relief to some less good news, alteration and renovation. So this is just sort of the refurbishment of a single dwelling or refurbishment of a single RRP or RCP. That is generally not covered by reliefs if you're just retaining the same sort of format, same structure, and same number of units as there were previously. There are a few exceptions for this, which don't come up all that often, but are certainly very, very valuable when they do. And the broadly sort of the empty home conditions. So if you have a residential property that's not been used for a residential purpose for the last 10 years, it's effectively treated as non-residential, and therefore potentially you can get the zero rate on it when you are doing works to it to make it fit for habitation again. And a similar relief applies for 2 years. So if a unit's been out of use for 2 years, then it is able to, the renovation and alteration to it is able to take the 5% reduced rate. The key factor for both of these things is realizing that it's been out of use. Sometimes it's very much obvious. Sometimes it may not be, especially for the 2 years. It may just have been sort of out of circulation for a while, not needing a huge amount of work, but can still take a much lower rate of VAT than you'd usually expect. And the second key thing to remember is that this will need to be evidenced to HMRC if they inquire. So you would want some sort of document to prove that there had been out of use, not been occupied, whether that be sort of documents from the local authorities, probably the usual one we see, just to make sure that HMRC satisfy themselves, if required, that actually this has not been used for a residential purpose in the last 2 to 10 years. And the final one for alteration is a very niche one now on the sale of a protected building. So this used to be a much wider relief prior to George Osborne changing the rules back in 2012, I think, which allowed sort of much greater renovations of old listed buildings. Now, if you have a listed building and you want to have it refurbished, then the only way you can really do that is by effectively gutting it and selling it on to an associated entity. It needs to be substantial reconstruction, so it's pretty much just the core and shell that needs to remain. So again, very niche, but if you do have any listed buildings, it's worth having a look through the relevant details for it to see if it could possibly fall within that relief, even if it requires perhaps a bit of restructuring, a bit of sale between entities. Next slide, please, Lynn. Right, certification, RRP and RCP. So these are, I suppose, legislatively trying to mirror the reliefs for zero rating of new dwellings, but they are significantly more complicated and come with significantly more risk. While zero rating for dwellings can be quite complicated in some situations, broadly you can be relatively happy that if you're designing a classic new build, conducting a classic new build set of residential units or flats, it should fall into the zero rate, absent something being going very horribly wrong. If you are building a new RRP or a new RCP, so that's relevant residential purpose building and relevant charitable purpose building, you can still get a zero rating for them in most cases, as long as you do meet the conditions and as long as you certify you meet the conditions. So I'll go into a little bit more detail on the next slide, but relevant residential purpose is broadly dwellings that don't, places to live that don't quite meet the definition of dwellings because they might have shared access or might have shared facilities, and relevant charitable purpose is sort of used by a charity for a non-business purpose. And you can get the reliefs in two ways. You can either get it via zero rating construction. So someone will build on your land and they'll provide you with construction services, and you'll provide them a certificate, and then they will zero rate their services to you. Which again, they're very, very good compared to the alternative, or via a zero rated sale. So in that case, you as a charity or you as a housing association would buy a RCP or RRP from the developer, and you would provide them with a certificate to say that you are using it for the correct use, and then they will zero rate their sale to you. They are different certificates. They are very, very similar certificates, but they are different, and they have slightly different implications for that. Probably the main one being, if you are buying construction services, you must be the one certificating, and you must be the one who's going to use the building for the purpose you say you are on the certificate. Whereas if you're just getting a zero-rated sale, you can act as a middleman in that. So you can see in the two sort of diagrams put down there. In the zero-rated sale, someone can certificate it's going to be used for a charitable purpose who's not a charity, as long as they themselves are sure, thanks to their onward rent they're going to charge the charity, that they know it will be for a charitable purpose. That can't happen within zero rated construction services. If you certificate, you must know that you are going to be using it for your own purpose. Similarly, the certificate can only be passed down once down the chain. You won't have a chain of zero rating like you might have within dwellings. So if you are a supplier, you need to make sure that you're supplying to the person who's actually going to be giving you the certificate properly. There are various penalties for failure to provide a certificate, failure to provide an incorrect certificate. Broadly, they mean you have to pay the amount of VAT you would have been charged otherwise. It's probably slightly worse than paying the VAT in the first place, because there's no way you can recover it, because it's not VAT, it's a penalty. And you will, I'm sure you've all seen many, many cases going through the courts of someone trying to ensure that their building is zero rated and failing on one of the very more extreme or esoteric conditions, and then having to take HMRC to court, not generally with a great deal of success, because the rules are what the rules are, even though they are, let's say, quite complicated and quite convoluted for the policy aim, which is policy aim makes sense, but in practice it's a very difficult condition to get it often. If you might go to the next screen, Lynn. So the primary conditions for certification, i.e. what you're going to use it for. So for a relevant charitable purpose, it means the building needs to be used by a charity. So charity broadly meaning sort of one registered charities commission or otherwise registered, so industrial with the FCA in terms of RPs, for example, and it must be used otherwise in the course of business. So that's quite a tricky one, because a lot of charities, although they are charities, and certainly for corporation tax would be seen to not be doing business activity subject to corporation tax, they can still be business for VAT purposes. So, for example, take a moderately extreme example, private schools, charitable for corporation tax, but in the course of business for VAT. So they would not be able to take advantage of RCP certification, even though they might be a charity, and even though they're doing something you might see, or certainly for corporation tax, is seen as charitable. So instead, you're looking at sort of the much more grant-funded and donation-funded charities. So for an example, a call centre being built for the Salvation Army. There's no money being generated by that. There's no profit. It's all being funded by donation and being carried out by a charity, not in the course of business. So that's the sort of thing you'd be thinking of for our RCP. Another one that you can use is village hall or similar. Again, practically, there have been so many court cases about what a village hall or similar is. HMRC take a very limited and restricted view of what it is, sort of honing back to maybe a 1920s post-war sort of village green sort of style of what that means. So it's, if you are going to use that, I would certainly recommend you take advice on whether it falls within a village hall or similar, because it's not nearly as wide as you might hope by the term village hall. RRP, a little bit, I think, less contentious, apart from around the margins, given there is a list of what it includes. So children's home, care home, hospice, student accommodation, or institution, which is the sole or main residence, 90% of its residents. So yeah, school, children's homes, care home are sort of the big ones we see, as well as as well as student accommodation. Although it's worth saying, if you can get student accommodation within the definition of dwellings, that's better, because you sidestep all the certification requirements and you sidestep the next thing on the next slide, which can be pretty unpleasant, which is if you do certify RRP or RCP use, you then have as part of the certification process, you have a requirement to monitor the use of the building for 10 years. And basically, if it starts using for a non-relevant purpose, so less than 95% for your charitable or your residential purpose, then you get a self-supply VAT charge. And it's basically intended to make sure you pay the amount of VAT you would have paid in the first place if you hadn't provided the certificate. So it can be pretty punitive, particularly where the amount of, especially when you have situations where you're disposing of the building, because a full disposal to someone else, even if they're going to use it for a relevant charitable or a relevant residential purpose, can still absolutely trigger the self-supply charge. And it's, yes, a relatively common risk area, especially for care homes, because of the OPCO structure. But it needs to be thought about. Sometimes that can be recovered, so it's not always necessarily a cost, but it is one that can often get forgotten, especially 5-6 years down the line. As you spend more time using it for its relevant purpose, then the amount you have to pay back diminishes. So it goes in a sort of a straight scale from full amount on day 1 to 0 at year 10. And throughout that time, as things change, or if there's a disposal, you get the amount of that sort of prorated across those 10 years. So it's can be significantly punitive, and certainly a lot more than you might expect from, say, the capital items scheme, which this sort of has some similarities to, but is often comes with significantly higher amounts than the CGS would do. Next slide, please. Cool. So moving on to a newer relief, sort of anyway, energy saving materials. So these used to be 5% reduced rate for the last 20 odd years, I think, as a means of encouraging environmental and social benefit. It was subject to a long-running lawsuit with the European Court and the European Commission about how far we could extend the 5% rate. But post-Brexit, an opportunity was taken to expand it and make it simpler. So there were a number of very stringent conditions on who could use this. You had to show sort of a social need, so someone on some sort of government benefits. Whereas now, from I think it was April 2022 last year, you can now apply the zero rate to any services of installation of these things and associated goods on a residential property. So it does not include the purchase of the goods themselves. So it needs to be services and maybe then associated goods, rather than just purchase the goods from down B&Q or wherever else you might go. It's also slightly widened recently in terms of it has now wind turbines and water turbines are included. I'm not sure practically how much difference that will make, or whether wind turbine and water turbines are all that commonly installed on residential properties, but it is slightly expanded. The main ones we see are insulation, solar panels, and then sort of draft and heat pumps sort of increasing popularity. We'd expect that to sort of increase further as the market develops in that, and there are better heat pumps being developed, frankly. Thank you. The issues with this zero rate are two main ones, I'd say. One, if you're residential accommodation, I mean, that's kind of what you expect, so that's all right. The second is that what you might call insulation is smaller than you might expect. So it's not really what the purpose of the new materials is that matters. It is instead what it is. So the classic one recently seen in court was whether the installation of a new roof that was designed to basically insulate itself, to be much better insulated, counted as installation or as installation of a new roof. And the court said it was a new roof, and so no reduced rate as it was then. And you sort of see this quite a lot in that there are things that you would sort of naively expect to be within the relief that are not. Sort of a lot of things involving boiler systems and hot water systems. While the controls for a hot water system may be zero rated, the actual boiler system itself may not be. And these things do catch people out and do mean that the relief doesn't really get to as much of its policy aims as you might expect. The second big problem, particularly for developers and housing associations, is that unlike with the other release Glyn mentioned, there is no apportionment provision within the ESM. So that is, you can't say, well, actually, we're doing a renovation of this to make changing it from 4 to 6 units within this building, and we're also going to do the insulation on the outside as well. You wouldn't be able to get half of that insulation, half say zero rated, and the rest of it 5%. They're just provisions aren't there in legislation, which is possibly a bit of a lacuna in the law, but it means that it's very difficult to get a whole construction project zero rated under the ESM conditions, because you're going to be doing construction work as well. You're going to be doing renovations. You're going to be making things better in terms of the electrics, in terms of the plumbing, in terms of making sure it can survive the elements. So HMRC's general view is that those things mean it's no longer a supply of energy-saving materials, but it's a supply of something else that includes energy-saving materials. So you're into multiple supply questions. And HMRC's view, as you might expect, is that it's pretty rare to have a zero-rated energy-saving materials piece of work that extends significantly beyond the materials themselves. Even though obviously it makes a lot of, if you're going to do a load of installation, installing, you're going to be putting together a sort of a new lick of paint and a new tidying up of a renovation of a block of flats, for example, a substantial part of that might be ESM, but you'll get no credit for it in the VAT liability. I think that's back to Glyn to finish off on retrofitted cladding.
Thank you, Chris. Let me just put myself back on video and move the slide on. There we go. So it brings us to our last topic of conversation, which is around the replacement of unsafe cladding. Now, obviously, this relates to the rules that the government put in place following the absolute tragedy involved with Grenfell. What that's basically meant for, as you'll be more than a little bit aware, what that's meant for the social housing sector is that we've had to go back and have a look at a lot of our units to make sure that the cladding used on the outside of these buildings is safe for the inhabitants, and obviously we know that that's compulsory for buildings of a certain size. Now, the first thing to note is don't forget the energy saving materials bit. It's possible to get under there, but actually the revenue tend to apply that condition that Chris mentioned, and that is that you can't apportion it between one purpose and another. So if it's a general purpose, then probably not. If not, we're relying on the that the revenue produced now on snagging and remedial works, and we'll talk about that in a bit more detail. Now, I know that a lot of people across the sector have got a variety of different rulings from the revenue that vary in their generosity from incredibly generous through to being a little bit parsimonious. So I think the learning point for people who have got those rulings is to fish them out, dust them off, have a read through, and make sure that they're not narrower than the current guidance, which I'll go through with you in a second. To make sure that they're not too narrow, because if obviously the guidance is there, then they're worth challenging. Or if they are more generous than that, obviously you should be able to rely on those, providing you have put all the facts into the revenue's hands. And this comes down to a bit of an oddity in VAT rules, which basically means that if you get guidance to your detriment from the revenue, and the revenue had all the facts in front of them, that you should be able to rely on those rulings. That is still in place. Some of the legal structures, I know there was a little bit of panic a few years ago. Some of the legal structures were dismantled, which made it a little bit more difficult to compel the revenue to apply their conditions. But providing you have made a full disclosure of the facts, and providing the revenue have provided you with categoric guidance, you should be able to rely on those. So if you do have very generous ones, lock them in the safe, don't let them go, make sure you don't lose them. So obviously, with the amount of money going into the retrofitting of cladding across the social housing sector, and indeed across the construction sector, the amounts of money involved are very, very large, and the revenue were presumably inundated with requests to treat this in different ways. So what the revenue have said is that they will allow the cladding works, the recladding works, to be zero rated, provided and only if the initial cladding was part of a zero rated construction. Now that means that you need to, the building that you built has to be a zero rated one, not just a refit of an old building or putting cladding on an existing block of flats. But if you built a new block of flats and you put cladding on there, and it was initially zero rated by you, and you can demonstrate that, you should be able to get zero rating on the retrofitting of the cladding. Basically, what we say is that it's further, it's just effectively snagging. So, okay, so the snagging is occurring 20 years later, but the initial cladding was defective because it's not safe. It has to be removed and replaced, and therefore it shares a zero rating with the original construction. So, I mean, you can see that's quite a stretch, but the revenue are obviously quite anxious to not to allow VAT to get in the way of works which are absolutely necessary for the safety of tenants. The other conditions, the cladding needs to be on the original plans and was part of the construction. We have seen situations where buildings were built and then later somebody decided that actually it would look a lot better with cladding added to it. If it's not on the original plans, then the revenue is saying it doesn't apply. The property still needs to be owned by the original developer or freeholder. Now, this is a real pain, particularly for those of you who've gone through multiple mergers and changes. If you're in that situation, I think it's worth having a look at, depending on the amount of money involved. The revenue are saying that actually you need to have that person constructing status, so you need to be the person who originally had the development. So coming back to the purpose of that relief is to say, well, effectively changing the cladding is snagging. But you know, if you have gone through mergers and things, it is worth clearing that with the revenue to make sure that they still see it in the same way. To a degree, it will come down to what you can show and what you can prove. The cladding work needs to be carried out because it's unsafe, not just to make the property look a little bit better or to increase the energy efficiency, which comes down to the initial conversation. And the developer, it has to be you that organises replacement of the cladding. That generally won't be your problem if that doesn't happen. But if you're getting the tenants to do it, that might be more of an issue. The remedial work is done as soon as possible. I don't really understand what that means, and frankly, it's not a condition that I would be overly concerned with. So really, in summary, if you've got a more generous ruling, hold on to it. I know there are some around there that don't have those conditions in them. This is the guidance that the Revenue have released to people to use. So if you have not gained those reliefs recently, then please make sure you have a look at it and use those reliefs, because the cost of replacement cladding is obviously very large, and actually the VAT on that can be a significant cost to you, particularly where you've got rental streams. So I think that brings us to the end of the formal presentation, but I know we've got, we're lucky enough to have quite a few questions actually. So if I stop sharing my screen, then we can get the panelists in view, and I'll quickly have a look at these questions that have been raised. So forgive me, we're doing this on the fly, as it were. Chris, we're a housing association. If we convert standalone guest room into qualifying residential dwelling, can you get the full 0 rating on the conversion work?
No, you would not be able to, because it's not commercial at the start. It's a resi to resi conversion. So you get change number of use conversion. It's 5%.
Well, that was brutal. But when I concur with, unfortunately not. That's not going to be a thing. Moving on, if we issue an RRP certificate, this will mean the contractor can 0 rate but the subcontractors will have to standard rate. If we issue the RRP certificate late, would we need to ask our contractors to notify the subcontractor they have had a late certification, that the subcontractor has to now raise VAT-only invoices to the contractor? Sorry.
No, again, because the subcontractor will be raising 20% invoices anyway, because they won't have a certificate themselves, because certificate doesn't pass down the chain.
Okay. And we have seen the Revenue take the point there, by the way. So there have been situations where the Revenue have gone to the well, one of the issues you can often have with housing associations, and I should have mentioned it a little bit earlier actually, is the 0 rating for construction services only relates to construction services. One of the things it doesn't relate to is the any professional services. So it specifically excludes professional services such as quantity surveyors, architects, accountants, for that matter. All of those costs are always going to be subject to VAT. The way round that is to contract for the construction of buildings on a design and build basis. So somebody goes away and designs it and builds it for you. So you get a construction charge, which includes the building work. That is 0 rated in its entirety. And if you can't do that with the contractor, many of you on the call I know have got design and build companies, which are basically companies within your group structure, which basically do the same thing. They buy in those services from the construction company, and they buy in the professional fees, and they mix them all up in a shaker, and then they charge for those services on a design and build basis. So effectively getting the 0 rating for all of it and full VAT recovery on the costs. The one slight thing to remember there, that because it's a design and build company, because it can't issue certificates, it is, because it's not going to use those buildings, it is not going to get the 0 rated relief. So you're going to get tax in at 20%, although it's fully recoverable, and then charged onwards. And we have seen Revenue take the point, saying, well, look, actually, that's going into somebody who's also effectively in the chain of contracting, and therefore there is going to be no VAT relief on that. So other questions that we've got? Gosh, we've got some wonderful questions here. So thank you very much indeed for putting those in. It really does help bring it alive to put it into real scenarios. Does a change in number of dwellings relief apply if reducing the number of dwellings too? Go on, Chris. It's another long answer from you, I suspect.
Yes. So yes, it does. As long as the number of dwellings at the end is more than 0. So you can reduce from 6 to 4, 10 to 1, 2 to 1, but you can't reduce down from 3 to 0. It's just turning into something else.
Exactly. So change number of dwellings then is any change up or down then, basically. Cool. Excellent. So we've had a question on fire safety remediation, Chris, which is definitely coming your way because I'm not sure I know the answer. Is there any specific relief for fire safety remediation works and or waking watch while awaiting remediation works to be carried out?
So broadly, no. There are no specific reliefs. Certainly, waking watch by itself would be 20%, I think, in pretty much all situations. I think the only way you might be able to get anything on the fire safety remediation would be if you could, again, get it within sort of the wider aegis of snagging works or remedial works that should have been done and weren't done, even if it's not necessarily cladding. You might be able to push the sort of definition of snagging works to include it potentially, but yeah, it's probably not without risk.
Okay, and we've had a really good question on the retrofitting of cladding, actually. So thank you for that one. I thought the HMRC had recently told the Land and Property Group and the National Housing Federation that you need to do the work within a couple of years since the original construction. So practically not much use, question mark. Chris, do you want to start with that and I'll come back to that?
So yes, I mean, the guidance we've seen, though it has the last question Glyn mentioned about being done within sort of as soon as you can after realizing it, doesn't put a hard cap on the time since snagging has been done and then when the remedial works are done. I don't think it would. Yeah, I mean, I think unless it's part of HMRC's wider means of limiting the application of the sort of the cladding policy, which we know they have been doing. I haven't seen anything definitive on that from the NHF, but we are aware of some organisations potentially pushing some of the reliefs wide, some of HMRC's sort of guidance on this wider than HMRC expected. So I can imagine this might be something they are bringing up to try and stop that, or at least threatening to stop that.
Yeah, and I think what it comes down to is that final point on that we mentioned earlier, and that's remedial work is done as soon as possible. And as I say, that's a movable feast, really. If you're in situ, I mean, whether it's any use or not, I would definitely challenge that because I am aware of specific situations where the revenue have accepted it for quite a long period after practical completion. And there is no real reason not to. Obviously, there is a sensitivity there. So the revenue are going to look at that and go, can we really treat this as snagging historically? Now, comes down to those original rulings I discussed. So people who got in early and got the more generous rulings were not time barred in any way. That particular guidance, which actually does exactly was the guidance that was issued to the National Housing Federation and indeed to the Land and Property Group, which obviously BDO are on. There was no specific amount of time appended to that. But once again, if we're going to rely on it, you may want to look at getting a formal ruling from the revenue to the extent that that's possible these days. Not always the easiest thing because the revenue quite often simply parrot the policy. I do think it's still valuable. I still think that there is something there for people, and doing it remedial work as soon as possible. Well, there is no specific time limit there, I don't think. So whether an individual in policy has been more negative on those calls, I'm not sure. It's possible, but I would certainly be looking at it myself. So once again, in relation to retrofit cladding, could you please clarify the difference between the latent defect is and what snagging is? We thought that cavity barriers being missing were latent defects, so we're wondering if this would apply for zero rating under the rules. Chris, any thoughts on that? I thought that the rules were predominantly around safety, so it had to be part of the cladding work being unsafe, as opposed to anything else. So if they were just put in badly, then yes, of course, you might be able to get the zero rating under the normal rules for snagging anyway, to say it's part of the original construction works. If it's just so that the cavity barriers were missing. I think really the point for that bit of guidance is it has to, one of the conditions of that guidance is that the cladding work needs to be unsafe. So if it's a safety issue, then yes. If it wasn't a safety issue, then no. Chris, any thoughts before I move on?
No, I mean, I think it's not necessarily talking about cladding here particularly, but more sort of the general snagging. So generally, it depends, I guess, to an extent who's doing it. But if it's still part of it, if this building doesn't work, the building can't be completed or needs to be rectified, then I think you have a reasonable case to look at it again under the general rules around snagging as part of the construction of the building, so potentially zero rateable.
Cool. And again on cladding, am I right in thinking the revenue guidance talks about only applying it to completed buildings which are habitable and have residents in?
I don't see why there's any technical reason why that would necessarily apply, but I can also see the HMRC from a policy point of view would perhaps be less helpful for where the building is now uninhabited, and potentially maybe if it's been for, I think having an uninhabited building sort of means that you're likely to fail one of more of the sort of the tests they put out in the policy in terms of, have you done it fast enough? Is it just the cladding you're going to be doing, or is it going to be something else in order to make it livable again? So I don't think it's an absolute bar, but I think in practice it's probably less likely to apply.
I mean, certainly there's nothing in the guidance that says that, but I concur entirely with Chris. I think it's difficult to imagine many situations where you're going to have an uninhabitable building which is just simply going to be made safe for the inhabitants. It's almost like a contrary in terms. Having said that, if it's just a pause between practical completion and getting tenants in, or it's a later pause as to making it safe before the tenants, and then that might be a possibility, but it is very difficult to see exactly where that would go. I mean, it's not something I've specifically seen the policy take or the individual revenue officers take, but that not to say that isn't true, my friend, because I'm not entirely sure I've seen that exact situation, so it's possible that isn't happening. So one more on cladding. Getting a lot of interest on the cladding. So for cladding, if a company has purchased a property as a going concern, would it be able to qualify for the zero rated cladding refit, even though it was not the original constructor?
Yeah, I think you have a potential problem there. Certainly worth asking the question, but yeah, I don't necessarily, because you can make a sort of technical argument that transfer of a going concern means everything, including sort of the right of being the freeholder, were transferred at the time of the transfer. But I think there's certainly a significant risk HMRC would not see it that way.
Yeah, no, I agree, and I think this does cause us a bit of a problem. In things like transfers of engagements, Chris, I know that we've had specific rulings. Any thoughts about other forms of merger and transfer?
No, I mean, I think they're all broadly going to fall into you can make a reasonable technical argument and a reasonable sort of basis of fairness argument, but probably is going to be an argument.
It doesn't fit comfortably within that guidance, does it? And therefore, to the extent one can rely on guidance, which effectively was issued not in the normal way, so it's not a formal business brief or anything. It is slightly more difficult, I think, and I think where in doubt, I would say probably engage with the revenue and try and get them on side with it. You should get a reasonably sympathetic hearing. They should be aware of that policy flying around there, so it is possible. But it's certainly not something that you can just rely on as it was. So I think really, I think that brings us to the end of our presentation today. Oh, hang on. Sorry, let's go. We've got another one. We got a couple of minutes. We can deal with this one. Recladding. If the zero rating doesn't apply and you're hit with 20% VAT, then we could recover this through the levelling up grant for mid to high range buildings, or the developer's pledge grant, where the developer would invoice a housing association, but he invoiced housing simply would not pay. The fund would. ? Yeah, I mean, it is possible that you could recover that through the levelling up grant, I believe, but that's very, very specific to your ability to claim that grant, I would say.
Yeah,
I mean, you've looked at this, have you?
Yeah, I mean, it's just sort of a grant, so it's absolutely possible for someone else to pay it for you via one of the funds or anyone else. But obviously, it will depend on what they're willing to give you as a grant, and being charged 20% of that means that likely the grant is going to be less than you'd otherwise hope it would be, because it's got to include the VAT as well.
Fantastic. And with all the levelling up grants stuff, it is worth looking at how that impacts on your overall calculations. Particularly if you are a Section 33 body, we have come across a number of situations where Section 33 bodies, because of the levelling up grant, does get applied a lot to their business activities. You can end up with a real cliff edge on your VAT recovery on Section 33. So that is something we're actively working with a number of the Section 33 bodies involved in the application of the levelling up grant. So if that is of interest to you, let's have a chat, and we can chat through what we've been doing with others to try and get them within the rules. So I think that brings us to an end. Thank you ever so much for everybody attending and for staying right the way through the presentation. It is very much appreciated. And as I say, I particularly love the questions. There were some fantastic questions there, which I think really help us to understand where you're coming from, but also help everybody on the call to see exactly where we are. And so a big thank you again. Just leaves me to make one final point before I go, and that is really a plug for our future webinar events. And I will share my screen again to show you them. He said, hopefully. Go with that. And Chris, is that showing? Yeah. Fantastic. So on the 7th of March, we've got one for the accountants among us, a webinar on cash flow statements, basically to how to do those in the most effective way. The 8th of March on the national minimum wage. That is a thing that is increasingly becoming an issue, and that is promises to be a really fascinating webinar. I might actually log in that myself, and if not, hope to see you all at the finance conference. I'm not going to be able to make that because I'm double booked again, but certainly my partner in crime, Parol, and the Northern guys are definitely going to be at the conference, along with our audit and tax colleagues. So look forward to seeing you there. Thank you very much for attending. Great to see you all. Look forward to speaking to you again.